Public debt. So in this session, we'll go through public debt. We'll go through the classifications of public debt, debt ownership, maturity pattern, secondary debt market, and repo and reverse repo. So first, we'll go through the introduction to public debt. So public debt is difference between budgeted receipts and budgeted payments. So even before that, we have to see what is the meaning of public debt. Public debt is raised by the government to cover for the differences between budgeted receipts, which is government income, and budgeted payments, which are expenses, government expenses. So whatever deficit comes between these two, it will be raised as a public debt. The difference between government income and expense. If expenses are more, then the government needs money. So public debt will be raised. There are pressing significance when one thinks about public debt and the consequences mainly on the production activities and the distribution activities of a country. So this public debt is government debt or state debt, and the state borrows it to meet budget deficits, which was explained, to finance developmental activities and to cover other expenses of the government. Next, we'll take a look at what are the classifications of public debt. So public debt can be classified as internal debt and external debt. Now let us see what is internal debt portion of public debt and what is external debt. First, we'll go through internal debt. Internal debt of the Indian government comprises of special securities issued to the Reserve Bank and financial institutions, market loans, treasury bills, and other liabilities. Other liabilities, so it is basically it comprises of special securities issued to Reserve Bank and financial institutions, market loans, treasury bills, and other liabilities. Now, what are other liabilities? These are rupee debt under public account, comprises of small savings, state provident funds, public provident funds, accounts such as postal insurance, life annuity funds, reserve funds, and special deposit. Now, the Indian debt market includes money market and bond market. So it includes money market and bond market. Whereas in money market in India, the money that makes up the market is well developed with a fairly large turnover and with a wide range of financial instruments. The story with the secondary bond market is unlike the money market because it is stunted and very primitive. Hence, we can list down the instruments traded in the debt market as securities from the government of India. So securities would be there. It would also have treasury bills, government guaranteed bonds, state government securities, PSU bonds, commercial papers, certificate of deposits, and corporate debentures. There also exist aspirants of the debt market, which are fund managers, brokers, merchant bankers, who also plan to evolve into self-regulatory organizations in the long run. So the principal regulatory authorities of the debt market are Government of India, Reserve Bank of India, Department of Company Affairs, Ministry of Finance, and the Securities and Exchange Board of India. So that is basically internal debt. Now let us see what is external debt. Okay. So as per the Constitution of India, so external debt, when we define it, we have to see what is given in the Constitution of India. So as per the Constitution of India, central government and not the state government has access to external debt. So that is what is given in the external debt. So however, the central government has so far not been borrowing on a commercial platform, and all its borrowing are limited to assistance from external sources. So external sources like IBRD and IDA. So in addition to this, public enterprise in India is also allowed to resort to external borrowings, provided it is on concessional terms through lending arrangements made by the Government of India, though there is a recent move to dispense with the intermediation of government in the case of public enterprise borrowing. So public enterprise borrowing also happens in external debt. They are allowed to borrow, and it's also provided in a concessional term through lending arrangements made with Government of India. Now, explanations on higher external payment despite existence of a declining short-term debt to foreign currency assets. So we'll give some explanations on why there is higher external payment despite existence of declining short-term debt to foreign currency assets. So some explanations we'll just go through. So in India, the external debt is made based on original maturity. So the measure of long-term sustainability of debt and overall solvency of a country is reflected in conventional analysis by keeping track of the stock of debt by original maturity expressed as a ratio of GDP. Now, the recent development of crisis in Asia have shown that in an otherwise solvent economy, whenever debt by original maturity is reflected, suffers a serious liquidity problem. When the burden of servicing the debt exceeds foreign exchange reserve, seriously undermine a country's ability to contract new debt or extend the existing old debt. So upon a shift in market sentiments, what gets reflected again is a debt crisis for the country, which may not be on the radar to issue a warning signal in the standard measures of sustainability of debt. So in the context of short-term debt, this observation is especially true. And true is the fact that there is an inability experienced to capture cross-border bank liabilities and rolls over, imposing a downward trend or bias on debt measured in terms of maturity that is original. But you see, the debt by residual maturity in the foreign exchange market presents a true picture in terms of its impact on maturing debt and enables the authority to fine-tune debt management instruments prospectively, which may include interest rates and ceilings, ensuring sustainable external payments that brings about the integration of external debt statistics with the balance of payment. So there is an irony also which is faced by the country in this context. It may be higher external payment despite existence of short-term debt to foreign currency assets. So that concludes the explanations. Also, despite the increasing trend of external debt in early 2000, the key indicators have considerably improved over time. So in the later parts of the first decade of 21st century, short-term debt to foreign currency asset has also declined consistently by a decimal point, confirming that within the public debt, 10% make up total external debt and 90% make up total internal debt. A unique feature of external debt is its structure, which is why multilateral financial institutions like the IMF are not worried. Since for India, for our needs, 34% of our external debt is owed to IMF or World Bank, when only 18% is owed to bilateral aid agencies. This, in addition to the fact that over a third of our external debt is concessional debt, gives us relief in matters of discussing external debt in comparison to similar but other countries. So that concludes the explanations on higher external payment despite existence of declining short-term debt. Now, this concludes the classification of public debt. We'll move on to the next section, which is debt ownership. So more than 90% of government securities lie with the government or its quasi-institutions, and 10% lie with individuals, which would mean the state is self-sufficient. So that is what is to be said about the debt ownership. We'll also discuss internal debt trap. Okay, so that is some explanations which we will give for internal debt trap. So the following assumptions does not hold true. The assumption being an increase in the interest rate on treasury bills and government securities will attract large amounts of savings from the household sector. So this assumption does not or may not hold true. And this is the basis of internal debt trap, where there exist 4 parameters to counter any or all such arguments about the rise in interest rates helping or attracting large amount of savings from the household sector. So firstly, it is generally argued that government borrowing facilities asset creation, which in turn takes care of debt payment. The assumption is not true. Because in most cases, government borrowings are in most cases used for non-developmental expenditure, especially non-plan-based activities. Secondly, it's assumed that out of public borrowings, a significant portion is invested in enterprises that are productive. However, the real fact of the matter is that there are significant delays in the fructification of any asset made out of government borrowing, and as a result, the growth rate in debt burden continues to be unabated, in addition to interest burden that gets piled up after every passing year. Thirdly, as we know, government securities and treasury bills have a captive market where the share of household sector in that captive market is abysmally small. So as we know, the situation is not going to change in the next few years. And lastly, with the acceptance of monetary measures targeted by the government, the RBI can't absorb the government loan tranches, in particular the residuary portion of the government loans, as it was done some years ago. So the fact is, internal debt trap exists and as is so convincingly supported by the counter arguments. So that concludes the debt ownership. And next is maturity pattern of loans. Now there are three classes of loans offered by the central government and state government. Maturity wise, it is short term, medium term, and long term. Short-term loans are for a period of 1 to 5 years, where medium-term loans are for a period of 5 to 10 years, and long-term loans are for a period beyond 10 years. So of the central government debt, about 17% are short-term, 22% are medium-term, and 61% is long-term in nature. The government reserves long-term loans for capital outlay projects, so it gives sufficient time for developmental outlays where the maturities are well distributed. Also, one has to keep in mind that there are no double dated loans. None are repaid before the maturity date. So this concludes the maturity pattern. Next, we'll go through secondary debt market. So here we will see what is secondary debt market, and we'll also see what does the government expect primary dealers to do in the secondary market. So before that, we will see what is secondary debt market. So a secondary debt market is the financial market where securities such as stocks, bonds, options, and futures are traded. Now, the system of primary dealers would enable the development of an orderly secondary market. The MTM or move to market related rates of interest strengthens the development of secondary market, with primary and secondary market giving effective signals to each other. Now let us see what does the government expect primary dealers to do in the secondary market. So primary dealers act as market makers by giving two-way quotes for the securities. They are not the ultimate investors, but they should have the capacity to hold the securities till they are able to access them in the secondary market. Primary dealers are approved by Reserve Bank of India, and they help in placing the government securities by committed participation in auctions in primary issues. For OMO or open market operations, which is the purchase and sale of securities in the open market by central or federal banking institutions, which is used to regulate the supply of money. So for OMO by the Reserve Bank, the primary dealers act as conduit for those operations and provide signals for market intervention according to rules and guidelines which are given out by the Reserve Bank of India. Now, the RBI guidelines for the enlistment of primary dealers in government securities relate themselves to committing to bid a minimum amount, underwrite a particular part, achieve turnover, and maintain minimum capital standards, including assets such as risk-weighted assets under RBI regulation. The bank will also, on their behalf, extend current account and subsidiary ledger account facility and liquidity to support bidding commitments for these dealers and give freedom to deal in money market instruments favoring OMO by RBI. So upon successful completion, primary dealers are paid commission, including for underwriting of the security. So that is their contribution, or that is what they do in the secondary market. Now, a great amount of transparency is imparted with the development of the debt segment, that is debt segment in the National Stock Exchange, whereby duplication of transactions is recorded by the Reserve Bank under the SGL account. Several measures would reduce settlement risk in transactions and prevent diversification of funds in the case of transactions through SGL, including whatever is done in the system of delivery versus payment, which is DVP, in government securities, Mumbai, to synchronize the transfer of securities with cash payment. So these are the things which a primary dealer would do. And this is what the primary dealers would do. So we also have seen the subsidiary general ledger, which is SGL, and what are the measures which are included there. All the more, the liquidity of securities would improve by the existing setup of Discount and Finance House of India, which is DFHI, along with the setting up of Securities Trading Corporation of India, STCI, which would make more attractive holding of government securities in the long run. So this concludes the secondary debt market. Next, we'll take a look at what is repo and reverse repo. So what is repo rate and what is reverse repo rate? So repo is a repurchase agreement, that is a short-term loan where both the seller and the buyer agree to the sale and future repurchase of assets within a specific time period that is mentioned in the repurchase agreement. The seller sells the asset, also may have collateral, and promises to buy back the asset at a price that includes its interest at a specified time period. Repo are short-term contracts, mostly overnight transactions. For example, the central bank can boost money by buying treasury bonds or other government debt instruments from commercial banks, which infuses the commercial bank with cash and increases it or its reserve in the short run. Upon completion of the contract, the central bank resells them back to the commercial bank. However, a reverse repo is an act of selling securities and purchase of it at a profit at a later date. For example, a bank may borrow money from the Reserve Bank at a repo rate and lend money back to RBI at reverse repo rate. So this completes the session on public debt. Thank you.